All right, there we go. Okay, welcome everybody. My name is Kyle White, the Director of Education with Cooperatives First. It's so good to be joined by so many of you. Looking at our chat, it looks like we've got pretty big geographic representation here. Most folks here, it looks like, are located in Western Canada, although I do see a couple of colleagues from out east, and then way out east with a colleague from Zimbabwe. So welcome, everybody. And if you haven't done so yet, please do drop your name, location, and your co-op or organization in the chat. Let us know where you're joining from. I'd like to start our workshop or our webinar today in a good way. So I'd like to do a land acknowledgement and acknowledge that we're located. Cooperatives First's office is located on Treaty 6 territory, which is home to the Cree, Saulteaux, Dene, Dakota, Lakota, Nakota, and Métis nations. We acknowledge that this land was not ceded, but that the purpose of the treaties was to ensure the land would be shared. Indigenous people have been cooperating in these territories for thousands of years, and it is through cooperation that all of our communities will continue to thrive. For the bulk of today's session, I'll be sharing my screen with you so we can follow along on a slide deck. So if folks do have any questions, feel free to use the chat to ask them at any time. I'm going to make time for questions probably at the 2/3 mark for today's session, where we can talk about some of the basics of financial statements. And then I'll make more time at the end so that we can talk about some of the tips or advice for boards or members. But yeah, please do make use of the chat at any time if you have questions. It's always good to get them in there. I'll do a pass through the chat at each of those question periods, just to make sure everybody has a chance to get their question in. Okay, let me share my screen. You guys can check out my lovely desktop. And then I'll get my slide deck up and presentation mode, and there we go. Okay, how's that looking? Can everybody see very picturesque Fraser Lake, British Columbia? That's where that picture is from. Good. Okay. Let's go ahead and get into it. All right. I assume folks who are joining this webinar are familiar with financial statements. Maybe you've worked with them. Maybe you've had to work with them for work or volunteer capacity, but I'm assuming nobody here is an expert. If you are, you may know more than I do, because I'm by no means an expert in financial statements. I'm not an accountant. I'm not a bookkeeper. I've just served on boards for 10 plus years, and I work with co-ops and nonprofits all the time, and so I've gotten quite familiar. So our real goal in this webinar is to provide a decent introduction, so that folks kind of understand what it is they're looking at and what kind of information they can glean from a cooperative's financial statements. To do that, we'll look at some actual examples, and then answer some questions that folks may be having about how to interpret information, what questions you should be asking, or how to best present information if you're on a board and you need to report back to members. So the way we'll work through that today is kind of in two sections. The first half to 2/3 of our time together today, we'll just talk about what those financial statements are, what the balance sheet, operating statement, and cash flow look like. We'll identify some of the key terms, and we'll talk about some of the information that you can take away from those documents, what kind of story they tell you about your cooperative's finances. We'll take a break for questions. So if folks do have any clarifying questions or they'd like some input or anything generally, we'll have some time for that. In the latter part of our webinar today, we'll talk about some tips for boards of directors when it comes to preparing financial statements, presenting financial statements, and then managing some of those strategic decisions that will inform your financial statements, as well as some tips for members who will likely be receiving financial statements as part of your co-op's annual report at your annual general meeting. And then we'll round out today's session with a final Q&A. Okay, not seeing anything going wrong in the chat. So let's go ahead and get right into it. But if you do have questions, again, drop your question in the chat at any time. Okay. We'll start off pretty easy. What are financial statements? Broadly, whenever you see that term, we're referring to three documents, three specific reports. We're referring to the balance sheet, the income statement, and the cash flow. Collectively, those make up your financial statements. You may not see all of those when you're presented financial statements. You may see more than just those three documents. But broadly speaking, that's what most people are referring to when they say financial statements. And those three documents are intended to portray the financial health of your organization. Each of those documents tells a different part of your co-op's financial story. It gives anyone reading it an idea of how your organization is performing, how healthy it is, and how things are looking financially. And we'll go through each of those documents to try to dig into what each of those stories look like and what it includes and what you should expect or look for in each one of them. For cooperatives, the financial statements are really meant to be an update or a point in time snapshot of how a co-op is performing. For managers and board members, you're probably going to deal with these documents on a monthly or quarterly basis. Here in our organization, even, we have financial statements generated once per month, once end of month reconciliation takes place, so that the people who are working closest with the financials understand where we're at, how spending is going, if there's any risks. We get those documents monthly. Boards of directors usually meet less frequently, or some may meet more frequently. But a lot of boards will meet quarterly, and they'll do a financial overview or a financial assessment once per quarter. The members of the cooperative will usually only receive what are called the consolidated financial statements. That's a year's worth of financial statements consolidated into one document at the annual general meeting. And in our last session, we talked about what needs to be included in the annual report from the board of directors to the membership. It's required that the board provides a balance sheet and an operating or income statement to the members. And if your cooperative has had more than 2 financial years, that they must be comparative in nature. So you provide the two years side by side. What you might notice is cash flow is not included. So a cooperative's board is not required to provide a cash flow statement as part of their annual report. They only need to provide the balance sheet and the operating statement. Now, if your cooperative needs to undergo an audit, a financial review, additional to this then will be the auditor's report, and an auditor may well include a cash flow statement. So if you go to your cooperative's annual general meeting, it depends on the size of the cooperative, it depends on where you're located, and it depends on the complexity of how they've raised capital or how they're regulated. That will determine what kind of report you're going to receive. If you're a member of a credit union or a cooperative retailing service or cooperative retailing system cooperative like Saskatoon Co-op here in town, you could fully expect to get the full package. An auditor's report with those 3 financial statements and copious notes and explanations from your auditor. If you're part of a small housing cooperative that's quite old and has fairly routine financials, you may expect just a balance sheet, an operating statement, and maybe a written report from the board of directors and management. So it's going to look very different from co-op to co-op what those financial statements look like. And for boards, in case you're wondering where these things come from, most organizations will have some sort of bookkeeping software. QuickBooks, Sage, those would probably be the 2 most common. Every organization I've worked with has used one or the other of those, and you can easily run off monthly, quarterly, annual statements with those. I have also worked for very small organizations where they're volunteer run, there are no staff, and so they're created manually using Excel spreadsheets. You can do that. You can do that. It is tricky. Things won't auto-populate unless you're pretty skilled with Excel, but it will add a layer of complexity. You'll need to be much more attentive and careful if you're using something like Excel. But yes, you can do that. And if you are doing that, you're not doing anything wrong. But at some point, I would recommend, if you can, spring for QuickBooks or something like that. It just makes life a little bit easier when it comes to financial management. Your financial statements are going to look basically the same, whether you're a for-profit or a not-for-profit or cooperative. There are different things to look for in different organizations. How things like equity will be treated, or how profits may be allocated, or how taxation is reflected will be a little bit different from nonprofit cooperatives to for-profit cooperatives. I'll pay some attention to the things that are prominent on for-profit cooperatives, and then we'll touch down a little bit on how a nonprofit might present this differently. And we always do recommend working with a professional when it comes to financial management. I'm not. And so, again, I'm not an expert in this area, but I'm just giving a bit of an overview for things to look for, how to understand these things. But if you're talking about preparing and reporting on the finances of an organization, we always recommend working with a professional bookkeeper, or if you have to undergo an audit, with an experienced auditor. Okay, so those are the financial statements. Generally, a little bit of background. Let's dig in a little bit to each of these documents. And we'll start off with the balance sheet. And straight away, you may see different terms used than what I'm going to use. All three of these documents have different names. Different accounting firms have different preferences for what they're going to call them. So a balance sheet may also be called a statement of assets and liabilities, or a statement of member equity, any number of things. But usually a balance sheet is probably the most common term. And the balance sheet is meant to show a point-in-time snapshot of your cooperative's assets, liabilities, and equity as of today. It's called a balance sheet because the two sides of a balance sheet should equal out. Your assets should be equal to your liabilities plus your equity. And here's what one looks like. Now, this is a fictional company, but it does break down a little bit some of the things that you'll usually see on a balance sheet. And there's a few key terms I'm going to define for folks here. When we use the term assets, we're referring to the things that the cooperative owns that hold value. So that may be something as straightforward as cash, but it may also be, like accounts receivable, money that the cooperative is owed. So it can count on that money and that value coming back to the organization. It may also include buildings, land, equipment, inventory that's yet to be sold. It's things the cooperative owns or is entitled to that holds value. On the flip side of things, liabilities and equity are how that value has largely been financed. Liabilities usually refer to some form of debt, be it a loan or a mortgage, or money that the cooperative owes to somebody. So it may have an accounts payable, which means that it owes one of its vendors money. It has an unpaid bill that needs to leave, that needs money leaving the cooperative. It may also be taxes or salaries that have yet to be paid that need to. It's not uncommon to see this month to month or year over year if the statements were created while in the midst of a pay period, or before something has been remitted. So it's not uncommon to see these. They're not necessarily red flags, but just pretty routine. Equity. We like to define equity as the value of the cooperative's assets that the cooperative and its members own outright. You're not paying off a loan or debt. The equity is what is owned by the cooperative and its members. It's the members' investment and the earnings that they've retained over the years. So those are three big categories. Assets are the value of the things the cooperative owns. Liabilities are monies the cooperative must be repaying. And equity or owner's equity or member equity is the value of the co-op's assets that the co-op and its members own outright. I've noted current and long term on here. Current assets or current liabilities are values that are going to be accessible right away. So for assets, if we're talking about cash, current assets are usually things we can use and spend quickly. We're talking about cash on hand, bills that are about to be paid, or product that we've yet to sell but are going to sell in the near future. That's value that we can have ready access to. We can access the cash value of those assets. Long-term assets are things that are either fixed in place, they're not realizable for a while, or we would have to go through a major sale to access that cash. So as you can see from this example, this cooperative has some value tied up in land and its buildings. It would need to sell those buildings or that property to realize the value and access the cash that those assets are worth. And thus they're called long-term assets. It's similar for liabilities. Current liabilities are money that's going to be paid soon. It's value that's going to leave the cooperative soon. So accounts payable, paying a bill, taxes payable, remitting taxes, usually to CRA, versus long-term liabilities, which are liabilities that aren't going to be paid off in the very near future. A loan or a mortgage are the best examples of that. You'll usually see the terms payable and receivable on a balance sheet. Payable simply means that your cooperative has to pay that money at some point, usually in the very, very near future. And receivable means they're going to be receiving it from a client or an agency. So that's value coming to the cooperative that they can bank on. An important term you'll see, hopefully, in your cooperative's balance sheet are retained earnings. Retained earnings is the value that builds up over time in the cooperative. As the cooperative pays down liabilities, it repays its loan, the value of its assets will start to shift more towards equity. They'll start retaining some of that equity. As a co-op is profitable, it'll usually hang on to some of the value in it from its earnings through retained earnings. And over time, you want to see a shift from the liabilities to the equity section as the value of what the co-op and its members own outright starts to grow. Another term that I've added here that you won't see on a lot of co-op balance sheets, but you may come across is goodwill. Another one might be intangibles. Goodwill is often in the assets section, and it reflects the value of a brand. Walmart, for example, will have a very large goodwill because the value of Walmart's brand is considered quite substantial. And so it's tracked on the balance sheet. Things like intangibles will include trademarks, brand recognition, credibility, things that aren't tangible. You can't, buy these and add them to the cooperative, but nevertheless, they are deemed to hold value. So you may see things like that on a balance sheet as well. Okay, so that's kind of a balance sheet 101. There's a couple of important concepts to consider here. And I start with this first one because we often deal with startups. And I know many folks on the call are dealing with startup cooperatives. It's not uncommon for startups to have a negative equity position. Again, your balance sheet will always balance out, but that may mean your equity is negative. And the reason for that is if your cooperative is borrowing money and you're going into debt as your primary tool for capitalizing the cooperative, you may not have the assets equal to that borrowing. For example, if you're borrowing a lot of money to do leasehold improvements and buy furniture, you're probably not going to have a one-to-one assets to liabilities because you don't necessarily own the building that you're going to operate in. And so in cases like that, the co-op may be in a negative equity position. And ideally, that'll change over time as the co-op is profitable, as it pays down its liabilities. It should then bring up its equity value. Some terms you may see in a for-profit cooperative in particular are allocated versus unallocated equity. In our example here, we just have paid-in capital, which is the capital that a member or shareholder purchases when they join the co-op. And we have retained earnings, which is generally the equity. Some cooperatives will break that down into allocated versus unallocated equity. When a cooperative, I'm sure most of us are part of a credit union or a cooperative retailer, when a cooperative allocates its patronage to members, it will often retain a portion of the allocation made to members. The portion that's allocated to members goes into a pool called allocated member equity. It's held in the member's name and will need to be repaid to that member at some point, either when the co-op dissolves, when the member passes away, or should they choose to withdraw their equity from the cooperative. It's allocated to the member. Unallocated equity is generated from business done with non-members or from earnings retained by the co-op prior to allocating patronage to members. I have a handy chart that'll show how this all breaks down later on. But that's an important concept you may see on certain cooperatives is if they're allocating equity in a member's name to member accounts versus unallocated equity. For a nonprofit cooperative, you're probably only going to see unallocated equity or member equity generally. And that's because members don't realize the gains from a cooperative. They don't necessarily withdraw their capital from the co-op. It just goes into one pool as the co-op grows. Another important point to make here is a balance sheet can be a little misleading, in particular with the value of assets. And if we look here, for example, the value of land or buildings, it can be pretty tricky, I would say, for accountants and a balance sheet to get right the real value of land. Certainly in Canada, the value of land appreciates very quickly, especially in our major cities. And so the value presented on a balance sheet may not be the actual market value today of the cooperative's land. Usually a cooperative will not realize the appreciation in that value until it sells that asset. So again, just something to be aware of that a lot of cooperatives that own property may be in a slightly better position than might otherwise be portrayed. Another important term that you might see in a cooperative's balance sheet are its indivisible reserves. Many cooperatives will set up a indivisible reserve as funds that are not to be distributed. It's meant to be there to preserve the cooperative, and depending on the area of work where the cooperative is operating may be mandatory by a regulator. Indivisible reserves aren't meant to be distributed to members, regardless of whether or not the co-op has dissolved or not. A big challenge that we talk about in some of our online courses are some of the risks associated with equity in a cooperative. If you look at different examples, particularly agricultural cooperatives, members will usually grow their equity, their allocated equity in a cooperative over time. And then when it comes time for them to retire, they're going to withdraw that equity from the cooperative. That can have a serious problem on the cash availability of a co-op. If you think about having an agricultural co-op with 50 members, and all of a sudden 40 of them are retiring within the same year, there may be a lot of demand for those members to pull their equity from the co-op, which means a lot of cash has to leave the co-op. And so there's big risks with that. It might bankrupt the co-op. It might make them have no access to cash. It may put them in a bit of a crisis where they're not able to bring in new members. So boards should really have a plan in place for how to redeem equity, how much they want to build up for each member over time, and just be cognizant of the risks associated with that. And finally, receiving a grant, which is kind of like free money, or paying off debt will usually have a similar effect. In particular, if you're using that grant to purchase assets or things that hold value for the cooperative, you're going to increase the co-op's assets. And on the other side of the equation, that's going to go under equity. So receiving a grant will often bolster the equity and the overall value of the cooperative. Similarly, if you take out a loan to buy an asset, over time, as you pay that off, you'll see the equity go up as liabilities comes down, reflecting the value of your asset. So those are a couple of things that, as members, if you're looking at a balance sheet like this one, that's kind of the story that's being told. As you're paying down, this long-term liability, you'll probably see the owner's equity go up. The value of this land and these buildings may in fact be a little bit higher than what's being portrayed here, but the co-op can't really realize that value unless they sell the asset. If a cooperative is owed a ton of money from its clients, that might be a problem. In particular, if they don't have a lot of cash at hand, they may not be good at collecting on their invoices. And similarly, if their payable accounts are really, really high, there may be some concern that they're not good at managing cash and paying their vendors on time. Those are all things you can watch for in a balance sheet, and they're questions that you can pose to your co-op. Okay, let's move on to the operating statement, number 2 of 3. I will say the operating statement or income statement or statement of profit and loss or statement of net savings has probably the most names. So I don't know, you might see a whole bunch of different names for this one. I just call it the income statement or the operating statement. But yeah, here's what it is. What this portrays is a snapshot of a co-op's financial performance for a specific period. Again, boards or managers may be dealing with monthly or quarterly operating statements, but as members of a cooperative at an annual meeting, you're probably just dealing with the financial year, the 12 months of the co-op's fiscal year. And what it portrays is the income, expenses, and expenses of the cooperative. It should show you in a given financial period, was the cooperative profitable or did it lose money from its operating activities? What it doesn't show is investments and financing activities. We look to the balance sheet for some of that, and we look to the cash flow for some of that. But it just shows from an operational perspective, income and expenses, was the cooperative profitable? So let's take a look at an example. And for these next two examples, I'm using a cooperative retailer as the example. I've clipped out their name, but you could probably figure it out if you're a member of this co-op. So let's define just a couple of these terms. I probably don't need to explain some of these. Sales, I think we get what sales are. It's selling goods. I probably don't need to explain expenses. They're the things that cost money in a business. What I will just note, because it is kind of industry specific, is cost of goods sold. Because this is a retailer, obviously they have to buy their goods from a wholesaler and then sell them to the public. So the cost of goods sold is the cost of the goods that they paid the wholesaler. Sales are what the customers paid. Your margin or gross margin is what the co-op made after it's paid its wholesaler. So it's really what they've got to work with to cover their expenses. An important term that you'll often see in a operating statement is amortization. It's not reflected in this one. I believe it's caught in one of these budget lines, like operating and administration. But amortization refers to the depreciation of assets in a organization. And you can claim it on your operating statement as an expense because you don't claim debt. You don't claim debt payments on your operating statement. You can claim amortization, which is the depreciation of assets, and you can claim the interest paid on loans. But if you have a mortgage, for example, you claim the interest, not the actual mortgage part. Amortization helps reduce the co-op's net income. One of the advantages of reducing your net income or your profit is because it's your operating statement that helps you calculate the taxes that your co-op pays. And you can kind of see here the income tax expense that this cooperative paid on its net income, or its savings before taxes, if you will. Another key term that you'll see here for-profit cooperatives is patronage allocation. That is the amount being given to the co-op's members as their share of the co-op's profits. Important to note that a cooperative will pay out its members through its patronage allocation before paying taxes. This is a good advantage that cooperatives have for reducing their taxable income. We have some resources on a few of these key concepts that I'd be happy to share with folks who want to learn more about them. But you can see here the patronage that the cooperative pays out. And finally, retained savings, net savings, gross profit or net profit. These are things referring to the actual profit at the end of the year that the cooperative has left over once everything is covered. Okay, so there's a good snapshot, quick overview of your co-op's operating statement, income statement, whatever you want to call it. I think this co-op calls it a statement of net savings and a statement of retained savings. So, yes. Okay, so just some important concepts and things that you can look for here. Your taxes, the co-op's corporate or small business taxes are paid on the net income of the co-op. Not all expenses will be reflected in this document. As I mentioned, the principal payment from a mortgage or from a loan won't be reflected here. The interest payments will be. Investment in capital may not be reflected here. If you're purchasing a new building or new land, that'll probably be reflected on your cash flow as money leaving the co-op, and it'll be reflected on your balance sheet as the asset and then the liability or equity that you finance it with. But it won't be reflected on your operating statement because it's not an operational activity. It's an investment activity. And similarly, share redemptions and money leaving the cooperative through share redemptions when someone retires or they pass away, that'll usually be reflected on the balance sheet or cash flow. It won't be reflected on your operating statement. And again, very important for cooperatives is that patronage payments reduce your co-op's net income. It's a good advantage that cooperatives have. Okay, so that's kind of an overview of your cooperative's income statement or operating statement, which focuses on your income and expenses from operations. Let's move on to our last one, which is arguably the most tricky to interpret, and that's your cash flow statement. Your cash flow statement, as its name suggests, is intended to reflect the movement of cash in and out of the cooperative. We'll get into it, but it provides a snapshot for the cash position and the sources or destination for cash in a specific period. This is usually has to be paired with the operating statement and the balance sheet to make good sense out of. And what it does is it adjusts all the non-cash activities from a co-op's operations and aligns them with the different investment activity and financing activity that a cooperative does that allows cash to move in and out of the organization. That probably sounds confusing. Here's an example. So the cooperative that we just looked at, this is their cash flow statement. And what you can see is there are primarily three sources of cash in this cooperative, in all organizations. There are operating activities. So ideally, as the cooperative operates, it makes sales, it's profitable, it's bringing cash into the organization. And what you're seeing here is it's adjusting for things that are not actually cash moving. For example, amortization or depreciation is value, but it's not actually cash moving in and out of the organization. And so your cash flow will adjust for that. Investing activities have to do with making investments in other organizations, but also usually for cooperatives, your members making investments into the co-op. And so you might see things like share redemptions reflected here. So if your co-op is redeeming shares from members who are withdrawing, you're going to see that money leave the cooperative, that cash leave the cooperative. If your cooperative is doing a big capital call and you're selling investment shares to members, you may see money coming in to the cooperative or cash coming into the cooperative through the sale of shares. And you may see financing activities. You may see a cooperative repaying capital, repaying loans. You may see them taking on debt to finance activities, these sorts of things to bring money in or pay money back. And in sum, what this should show you is how the cooperative is spending its cash. Where is it getting cash from, and how is it distributing that cash to these different options? The real important things to watch for here are where's money coming from? Ideally, you want it to come from operations. Ideally, you want co-ops to be self-sustaining. You want their operations to fund the rest of their activities. If a cooperative is always borrowing money for cash, that can obviously be a red flag. Similarly, if a cooperative is investing too much money, or it's losing money on operations, you may see the value of its cash going down. And that, again, can have negative implications. It may put them into a position where they need to borrow money to finance operations. So generally, you don't have to see the cash position of the cooperative perpetually increase, but it is nice. Okay, so yes, is an extremely useful tool for monitoring cash shortages in a cooperative. It's important to know how much cash your co-op has access to so it can finance purchase orders, so it can pay people, so that it has unexpected expenses. It can pay that with cash at hand, but you have to be very mindful of where that cash is coming from. And this is a good way of assessing the health of your cooperative. Is it coming from operations because the cooperative is profitable, or is it losing money all the time on operations, cash that is? Is it borrowing money to finance operations? Is it paying back members in the form of dividends or share redemptions? Is it investing in new property and equipment, or is it seeking capital from members? All those things feed into where cash is coming from and how the cooperative is capitalized. Okay, so that's a pretty quick overview of our three financial statements, some of the key terms and concepts portrayed on each one. Let's take a quick pause, shift gears, and we'll talk about some questions. Okay. Not seeing any questions in the chat. Did folks have any questions? I'll maybe stop sharing my screen. And then, yeah, if folks do have any questions, do feel free to use the raise hand function or turn your camera on and give a wave or something. Or again, feel free to drop a question in the chat. Yeah, Neil, if you have a question, fire away.
Oh, hi, Kyle. Can you hear me?
Yeah, absolutely. Go ahead.
Sure. So I'm fundamentally I'm very passionate about cooperatives. I've talked to you several times on the phone. We launched we launched what I thought was a organics food. We wanted to set up a food cooperative, and unfortunately, because of COVID, we had to put that on hold. I want to restart that. In the meantime, of course, there was a group of people. I've been pitching people on the cooperatives. I think my last conversation with you was about the housing cooperative. So I'm working concurrently. I got two or three people working on the organics cooperative fund, basically getting organic foods and providing it as a co-op. There's three people involved right now on the organics cooperative, myself being one of them. The seniors housing cooperative, we've identified some land. I need some, one of the things we don't have, I'm, by the way, I am a management accountant, but I don't want to spend my time doing accounting. So I'm looking for, when I saw this webinar, I was hoping, is there, perhaps I need some help getting somebody to do the financials because accounting for cooperatives is very different. My world was the for-profit world in Toronto. So the cooperatives accounting, I just want to know, seems like it's pretty simple, straightforward. Any suggestions?
It's basically the same. In
Okay.
principle, it's basically the same. There's a few things that co-ops can do that other businesses don't do. The allocated versus unallocated member equity, the distribution of patronage prior to paying corporate tax are things co-ops that are a little bit different. We do work with what's their name? Ambient Bookkeeping Cooperative here in Saskatoon. They work
Oh,
all over the
okay.
place. They're a worker-owned cooperative of bookkeepers. They're usually who we'll refer to for
Thank you.
expertise on co-op accounting. Yeah, thanks, Neil.
That helps. Thank you.
Awesome. Vicky asks in the chat, do we have a guide published for this? We do have on coopcreator.ca some helpful resources on interpreting financial statements, reading financial information. We also have a new online course in our Introduction to Cooperatives series for co-op advisors. One of those modules is financing and growth, or co-op finance and growth. That does a real good deep dive into a lot of this material. Vicky, did you have a follow-up question? You're muted. Oh, looks like you're still muted there, Vicky. Let's try again. Hey,
There. Can you hear me now?
yeah, perfect.
Great. I too am looking for a financial officer
Hmm.
here in Winnipeg. Do you have anything like that? Do you know of anything like that bookkeepers collective that you mentioned in Saskatchewan?
You can certainly still work with them. They work out of province as well.
Oh, I didn't
Um,
know that.
oh yeah, absolutely. We've also worked with Wiltshire Consulting in
Okay.
Winnipeg. They have some good financial expertise. They mostly work with farms, but are very well versed with cooperatives. Yeah.
What was the name of that collective again?
Ambient Bookkeeping Cooperative. I'll drop their name in the chat. Yeah. And
That's always helpful. Thank
perfect.
you. That's my question.
Awesome. Thanks, Vicky. Mike asks, could I repeat the definition for indivisible reserves? Indivisible reserves are reserves of cash, equity that's owned by the cooperative or the cooperative sector more generally that cannot be divided amongst the members. So even in the event of a dissolution, it cannot be distributed to the members of the co-op. Often this is written into a cooperative's incorporating documents, or it's required by a regulator that monies built up over time in this cooperative must be donated, usually, to another organization with a similar purpose. Question in the chat, are you able to recommend any accounting software for a young cooperative? QuickBooks is probably going to be what I recommend to anybody. It's very user-friendly. It's perfect for a small organization. It's good for a decent sized organization. But yeah, QuickBooks is great. Any aspects that are difficult or to be mindful of for multi-stakeholder cooperatives relevant to financials? Not necessarily. I would say the financial statements that a member will see for a multi-stakeholder co-op probably won't present enough detail to really get into the nuances, but you could certainly ask questions of your co-op's board and management. For example, in the patronage allocation that a multi-stakeholder co-op will make will probably be different types of allocations to different types of members. If we think about a store, for example, that has employee members and consumer members, the calculation that goes into calculating a worker's patronage versus a consumer's patronage is going to be different. So some co-ops may provide nuance on that. The majority of multi-stakeholder cooperatives that I've encountered operate on a not-for-profit basis, or they don't issue patronage to all stakeholders. So they're going to look and operate quite similar to any other type of co-op.
Thank you.
Absolutely. Any other questions about our financial statements generally? Hearing none, let's get back into it. So I'll share my screen again, and we will talk about some tips for boards. So if you're on the board of a cooperative, and I suspect many people are here, or you're on the board of a startup, just a couple of things to keep in mind when it comes to financial statements. If you're on a board, check them. This is really one of your jobs as a member of the board of directors, is to monitor the financial health and well-being of your cooperative. There is no better and easier way to do that than by staying on top of your monthly or quarterly reports. One of the boards I sit on right now, our bookkeeper will just send them off to us every month, unprompted, and we can check it out. Do that. Compare them as well. Understand, what does this tell us? And if you have questions, ask them. The best piece of advice I could give to a co-op's board of directors is to keep your nose stuck in the business of the cooperative, but your fingers out. It's not really our job as boards to meddle in the affairs of the co-op. It's our job to ask questions, make sure the cooperative is doing well, and represent the interests of the members of the cooperative. And so asking questions about the cooperative's operations, debt management, its cash position, the plans of managers for growth, those are all things that we as board members should be doing. If you're in a startup stage and you don't have staff and management yet, that may look a little bit different. It is helpful to have different hats on so that when you're doing operational stuff, you've got your kind of volunteer hat on, but then when you're meeting as a board and you're being more strategic, that you've got your board of directors hat on. And if you're not familiar with financial statements, if you're not comfortable interpreting the financials of a co-op, take a look at some financial literacy education. There is lots of free material online. If you check out our website, co-operative.ca, you'll find some helpful resources that goes into how to read this information, what kind of decisions you might make as a co-op leader. And then if you check out our online courses, you'll see lots of examples and cases for how you would make these decisions as a board. The best way, I would say, to really get comfortable with the financials of a cooperative is to learn by doing. The more you engage with this information and the more you understand the operations of your co-op, the more all these things start to line up. The more the numbers help tell the story of the business, because really it should. As your value of your co-op grows over time, as your operations get more efficient and leaner over time, and as cash moves in and out of the organizations, all of that should match up with your experience as a leader of that organization. So the numbers should follow the activities that you see. Another thing boards should be doing is be proactive. As I've noted throughout, there are certain things that are maybe red flags for financial statements. They're good indicators for red flags. They're good indicators for risks. And there are certain controls or policies that boards can put into place to head off some of these problems. A really big one, for example, is developing an equity policy. As your co-op gets profitable, especially if it is a for-profit cooperative, as your co-op becomes profitable, it's important to figure out what you're going to do with that profit. It's probably not the best idea to take that profit and give all of it to your members, as tempting as that may be. A few of our clients will do that as soon as they become profitable. They reward members, and I understand the reason why. But if you want to grow and you want to expand and become a more healthy, robust cooperative, you're probably going to want to hang on to some of that money over time. And when you do that, you'll have to start making choices. Do you allocate that money to member accounts and declare it in the co-op member's name? Do you just have a large pool of unallocated member equity that members would only realize should they pass away or if the co-op dissolves? And if you're a nonprofit or you need to restrict the cooperative's equity, do you provide for indivisible reserves so that that money that's been created for the co-op sector stays with the co-op sector? All of those things can get divvied out in an equity policy to ensure that the decisions the co-op makes won't cause problems down the road. And similarly, you should have something in mind when it comes to debt management. A lot of cooperatives that we work with will place restrictions on management and boards and their capacity to borrow. It's not uncommon for co-ops in their bylaws or their articles to restrict the business of the cooperative when it comes to borrowing money, so that the board would need member approval to take on debt over X amount of money. The reason for that is that members are more aware and updated when the co-op is taking on a risk like that. Not that debt is inherently risky. It is the most common tool that cooperatives use to finance expansions and growth, is some form of debt. So again, having a plan or a policy or just general guidance, I would say, for management from the board is very good financial stewardship. And as I mentioned, when the co-op grows, use those co-op's profits for growths. And earlier on, I mentioned a helpful chart that I have. This was developed by our colleagues at the Canadian Centre for the Study of Cooperatives, and it really shows how decisions can be made in a cooperative, a for-profit cooperative, about using your equity. And this graph or this chart really highlights that difference between allocated and unallocated member equity. So if we follow this flow chart, we have net income, so the money that a co-op has earned after expenses in a year. They may allocate a portion for the money that they have earned from members. That's over here in, I believe, green, versus money that they've earned from non-members in, I think, orange. I'm colorblind, so this is probably not the best. I should have numbered these or something. But money from non-members will go down to retained earnings, and then the equity capital reserves. Money or net income earned from members, you get to tinker with a little bit. You could decide to take a portion of that and retain it as unallocated equity, so it flows back down towards the equity capital reserve. But then monies that are allocated to the members, and again, it's up to the board of directors, usually on recommendation from management, how much that will be, what proportion of a co-op's profits that will be. That allocated to members bucket will be your patronage allocation. The portion of that that's paid out is considered your patronage dividend or your patronage return. And the portion that's retained will make up your allocated member equity over time. If you get your statement, your equity statement from your co-op, it'll break that down very clearly. It'll break down what your total allocation is, what your member equity is at the beginning of the year and at the end of the year, and how much you're receiving in the form of a cash payout. And all throughout this, there's a bit of strategy that goes into it. The board needs to weigh and understand how much money do we want to declare in the name of a member? Because again, with that are some risks. If a bunch of members leave all at once, it can put a strain on the cash and the equity of a co-op. But you also, of course, want to reward your members for patronizing the co-op, for using the co-op. And these are some of the ways that you can do that. Hey, we'll finish off with a few tips for members of a cooperative. The members are really kind of the last line of defense. In a co-op, they're meant to hold the board and management accountable at the annual meeting and ensure that the cooperative is fulfilling its purpose. And so if you're a member of a cooperative and you're going to your co-op's AGM, here are some of the things you should be watching for. And if you follow co-op news closely, it's not uncommon to hear about co-ops closing. One of the biggest ones in recent memory is Mountain Equipment Co-op, which sold its assets to Kingswood Capital in 2020. If you look at the financial health of Mountain Equipment Co-op over the years, particularly as they prepare to go into 2020 and tackle COVID-19, they're not in a great financial position. You can find their financial statements audited by KPMG online. But again, take a look at those and have a discussion. Is this organization ready for a global pandemic? What risks does this organization have? In particular, how are they financing their expansions? Are they taking on a lot of debt to finance leasehold improvements? Are they having issues with inventory management, where inventory is sitting for really long periods of time and they're not able to bring more cash into the organization? Does the organization have sufficient levels of cash, or are they having to borrow to finance different elements of its operations or expansion? If something happens, like a COVID-19, what would that do to the co-op's income? If your co-op's generating a lot of money from storefronts, and all of a sudden that type of storefront has to close, is it prepared to do that? What would that mean? Those are all questions that you could ask your co-op's leaders to better understand your co-op's financial position and how prepared they are for potential risks. Similarly, is there a sufficient reserve for the cooperative? Or is the cooperative not hanging on to enough cash because it's paying out too much money, or it's not running its operations as profitably as ideal? All of those are questions you should be looking for as a member to understand the financial health of your co-op and any potential risks. Okay, that brings us to the end of our webinar today. I just want to thank everybody for joining. If folks do have questions, I'll be sticking around. But if you do need to hop off, here is how you can get a hold of me if you'd like to. And then if you would like to hear from Cooperatives First more generally, if you want to learn about more sessions like this one, feel free to join our mailing list. We usually send out a newsletter quarterly, and you'll get updates about different webinars, tools, resources, online courses, all of which is free. So yeah, do feel free to join the mailing list. Lots of good stuff in there. I do see a couple of comments in the chat, so I'll go through those to see if there's any questions. But if folks do want to stick around and ask questions, by all means, you are most welcome to do so. But if you had to leave, thanks so much, and have a great rest of your day. Okay, let's go for some questions. I do see one here from Neil. Can we sell memberships to non-residents? Yes, you can. You don't need to be a Canadian. You don't need to live in Canada even to hold a membership in a cooperative. But I believe you need to have at least 1/3 of your board of directors has to reside in Canada. I'm pretty sure, yeah, I'm pretty sure it's just 1/3 needs to reside in Canada on the board. But yeah, your membership can be pretty well wherever. Okay, any other questions? Oh, Damaris, you have a question?
Yeah, thanks for the presentation. I had asked a question about the accounting software. You mentioned QuickBooks, and I was wondering if QuickBooks allows for giving members statements, individual statements, or even allowing them to log in and check their own statement. Would you know? Because I think that's the one thing we are struggling with.
It should be able to run off statements for individuals. For example, if you're paying out shareholder dividends or patronage, you may want to provide something like an equity statement to a member, and it should be able to do that. Yes. I don't know if it would be as open as that. Like if you would want to give all of your members access to your QuickBooks account, it would probably depend on the size of your cooperative. But I don't think it's quite designed for that. Yeah.
Okay, because when I was looking at just glancing at it, didn't seem to have a module that allows for recognition of membership. It seemed like it's more of a very, yeah, I don't know, because I think the modules that would allow for membership, individual members' statement, I didn't seem to see from any of the modules. but I can continue checking.
Sure. And I should say, I'm not well versed in these softwares in particular. Touching base with a bookkeeper or getting I can definitely get a recommendation from our bookkeeper on what's the most appropriate software. But I would say QuickBooks fits 99 out of 100 people, I would say. Yeah.
Okay.
Yeah.
So who can I ask? You said I can get recommendation from who?
If you wanted to reach out to a bookkeeper, I would for all of these, I would always recommend working with a bookkeeper, even if it's just to set up stuff, because a bookkeeper is going to be able to set up your QuickBooks account so much faster than we will. So yeah, Ambient Bookkeeping Co-op is who we usually work with and who we refer to. I know they'd be happy to do that sort of work.
Okay.
Yep. Awesome. I see a question from Blair. What can make a negative retained earnings? Losing money. Yeah, if your cooperative is consistently losing money on operations, their net savings may be negative. Okay, any other questions from folks?
So I guess just to carry on this about the retained earnings. So the reason I guess a co-op can be not underwater with the retained negative and retained earnings is because of shareholder loans and stuff like that. Is that how I'm getting that?
By and large, yeah. Again, some cooperatives will get by on having consecutive negative years for operations because they can lean on members, shareholders, debt, things like that to keep them in a cash position that allows them to keep operating.
Okay, thank you.
Not ideal, but doable.
Yeah, right.
Okay, not seeing any other questions, so I'll go ahead and end the recording. I just want to thank everybody for joining this afternoon. You'll hear from me again in the next couple of days with a copy of the recording as well as some additional resources. But always feel free to reach out if you have questions or if you'd like to connect.